Hello, everyone. Welcome to our today's session. And today, I would want us to look at something very important here called IFRS 16. Basically, the concept of leasing. So leasing is now becoming a big thing globally. I mean, here you are. You would want to do business in town and you can't afford your own premises in terms of building them. So what do? You simply go to a landlord who has a good building in a good location. So then what do? You simply acquire the right to use his asset, could be in full, or basically a section of his asset. So then what you would want for purposes of getting some kind of assurance, assurity, you'd want in this case here a lease contract to be drawn. It could be a 5-year lease contract period. It could be 10 years. You know, you don't want to start a business and then when it picks up, the landlord kicks you out and at the end of the day, perhaps introduces the same kind of business in his own premises. Right? We have got uncouth kind of landlords, some of them outside here. Yeah, so we want some protection. So it's very important for us to have that contract. Now the question will be, how do we account for these lease contracts? How do we do financial reporting of the lease contracts? That shall be done under what we call IFRS 16. IFRS 16. So remember initially, from the lessee's perspective, the one in this case who is coming to take up the space for purpose of just using, the one will be given what we call the right of use. Initially, they could go and classify leases into operating and what here financing leases. That used to be there. And then in this case here, people discovered that at the end of the day, many lessees were trying to run away from liabilities being put into their financial statements. So they were basically classifying most of the leases as what here operational leases, and yet those leases had every element to do with what we call financing leases. Remember, financing leases must be always shown. That was the old standard, must be shown on the statement of financial position as what here liabilities. So if you want to reduce your liability, what were people doing? They were classifying most of the leases that they had into operating lease. Operating lease, of course, they were only paying lease rentals, so they were not disclosing the liability component. And yet, for sure, once you have signed that document, you are liable. So in this case, you're supposed to recognize a liability component. But now, ladies and gentlemen, with IFRS 16, there is very good guidance, and I would want to share some document with us here. This is a document that I would want us to read here. Great. So most importantly, you're getting this class from RCM Online College, and we are purely 100% what here, an online college. We believe that Zoom classes work magic. And we are always telling our students here to avoid expensive, ineffective physical classes. If you want our Zoom classes, this is our number. So this is Leases, IFRS what here? IFRS 16. IFRS 16 gets rid of operating lease, which basically showed no lease liability on the statement of financial position. So every lease now shows what here? A liability. Very important, but there is an exception here. In adopting the new standard, all leases will now be brought onto the statement of financial position, except in the following circumstances. Number one, leases with a lease term of 12 months or less and containing no purchase options. So we have items being leased to you, and these items are short-term items. Short-term items, you will stay with them for a period which is either 12 months or less. 12 months or less. Then automatically that kind of an asset should be accounted for, or rather in this case, you can avoid putting that asset in the statement of what your financial position. You shall expense it. right? But now remember, even if, for example, the asset you were given for a period of 5 months, and then you are given an option to purchase that asset, then you're given an option to purchase that asset. If you're given an option to purchase that asset, then automatically that cannot be a lease that you can avoid from your statement of financial position, yeah, as your asset, and of course you show the liability component. So if there is a purchase option, we were told that you are leasing it for now, but say after 5 months, this asset, there is a possibility of it being yours, then automatically you can't avoid. That is basically your asset. That's basically your asset. Now, number 2, the second exception, which can make you avoid putting a leased asset from the statements of financial position. We are told in number 2, leases, where the underlying asset has a low value when new, when the value in this case here is low, right? And the standard doesn't really tell us the threshold for this low amount, but basically they're guiding us here, such as if you lease personal computers or small items of furniture, right? Small items of office furniture, personal computers, a computer, for example, going for 50,000 etc. Then in that particular case, you can avoid having that list item as an asset in your books of accounts, in your statement of financial position. So that asset, the whole of it, don't even call it an asset, that item, the whole of it, its value should be expensed in the income statement. So what have we said? That all leases shall be captured in the statement of financial position. All leases shall be captured in the balance sheet, except what here? Number 1, short-term items, items that you will stay with, you lease for a period which is 1 year or less. Those ones you can say, no, I'm not going to put this in my balance sheet. I'm not going to put this in my statement of financial position. What do? You expense that asset. Or the second category of items is that should not be brought to the statement of financial position are those items that we are calling what here? Low value items. Low value items, of course, this is left at your discretion, but at the end of the day, you should be able to see that these low value items basically will be the movables, computers, office furniture, and those ones you can decide in this case here basically to put them in the income statement basically as an expenditure. I've bought this, I've in this case here list this for a small period of time, right? Or number 2, it's of low value. So the lease, everything, I just throw everything to the income statement. Nothing in this case here goes to the statement of financial position because really that's not your asset, which has got future economic benefits like that. Great. Now, ladies and gentlemen, from there, what else are they telling us here? Very good. So you're told here, therefore, the definition of what is a lease is super important as it affects the amount of debt shown on the statement of financial position. Here is that definition. A lease is a contract that gives the right to use an asset, the right to use an asset for a period of time in exchange for consideration. So, ladies and gentlemen, if it's a building that you have leased in town, then this building that you have leased in town can only be categorized as a lease if it gives us the right to use the asset. And then number 2, there must be some consideration we are paying. There must be like rent we are paying. If you're not paying, in this case here, rent, then you're not honoring your obligation. Then automatically that item cannot be captured in your financial statements, more so the statement of financial position. Remember, in the statement of financial position, as we shall see, once you have this right of use and you are paying your obligations, that particular item will be asset, right? We shall be having what we call the right of use of an asset. We shall debit, and then of course we credit a liability component. Very important. So in this case here, lease contract, it gives you the right to use an asset, of which at the end of the day, that right is not a free of charge right. You are paying some consideration. So I hope that is clear. Great. So there are 3 tests to see if the contract is a lease. Number 1, the asset must be identifiable. So if it's a car I have leased, I have to see that really this is the car, right? The car, or rather this asset must be identifiable. This can be explicit. That's it, it is in the contract, or implied, implicit. The contract only makes sense by using this asset. There is no identifiable asset if the supplier can substitute the asset and would benefit from doing so. Ladies and gentlemen, listen here. So if, for example, I've leased a vehicle, right? And this vehicle, for example, happens to be a V8 Land Cruiser, right? And then one day, in this case here, we have the owner of this asset, the lessor, coming and telling me one day that you take this, for example, Fielder, smaller vehicle. And then in this case, so he's substituting basically. He takes his Land Cruiser V8 and goes and leases it outside there, uses it for other benefit that will benefit, for other purpose that will benefit him, right? So if this person has a possibility of substituting, taking away my leased asset, then that will not be a lease. That cannot be a lease. Listen here. The third conditionality, they're giving us the third conditionality here. The customer must be able to direct how and for what the asset is used. For what the asset is used. So you're saying this is my Land Cruiser. If you've listed to me, and every time you are on my neck telling me you can't go that way, you can't use it this way, then that will not be a lease contract. Whatever we have with you will not be a lease contract. Remember, lease contracts will give me 100% right of using the asset. And the asset must be identifiable. It is that particular section of that building. In this case here, you should not be able to substitute in a way that will disadvantage. If I'm being disadvantaged by the substitution, then that is not a lease contract. Very, very important. And I must have exclusivity in terms of how I make use of this particular what here, of this particular leased asset. I must have that exclusivity. If in this case you're the one directing on how I should use it, then automatically that ceases to be a lease contract. So please don't forget that we are giving you this class from RCM Online College, where we strongly believe that Zoom classes work magic. Avoid too expensive class going for 20,000. Ineffective physical classes. Why am I calling them ineffective? Of course, once a teacher comes and they are able to finish their class, those classes are not recorded. Here for Zoom classes, we record and share, of course, recordings here with our students. So if you're interested in our Zoom classes, please call here. Call us here. Call us through this number of 0719. So we have examples here. A contract gives you exclusive, look at this language, use of a specific car. The car has been specified. You can decide when to use it and for what. The car supplier cannot substitute or change the car. So does this contract contain a lease solution? Does it pass the 3 tests? Number 1, is there an identifiable asset? If yes, the car is explicitly referred to and the supplier cannot substitute the car. So the car has been identified. So it meets the first test. Number 2, does the customer have substantially all benefits during the period? So if it's my leased car, I'm making use of it. Perhaps in this case here, I'm using it to move my clients here from one point to the other. So automatically I'm deriving the benefits out of this leased car. Second conditionality met. The third condition, what do we have here in the third condition? Does the customer direct the use? Yes, he or she can use it for whatever and whenever they choose. So yes, this contract contains a lease because it's a contract that gives the right to use an asset for a period of time in exchange for consideration. Very important. Look at example number 2. A contract gives you exclusive use of a specific airplane. I love the word specific airplane. The airplane supplier, though, operates it using its own staff. So we're saying, ladies and gentlemen, here that the supplier does not want to risk and give you an aircraft without his own pilots and, of course, other crew members, right? So he has told you that this is your aircraft. The only thing that he has done is basically to give you the pilot and the crew members there. Let's continue reading here. So we are told, ladies and gentlemen, that the airplane supplier can substitute the airplane for another, There's that possibility. But it must meet specific conditions. So there are specified conditions before it brings you this other airplane. It must be like almost exactly the aircraft that he has given me. So he can substitute fine. But in this case here, the one that he's bringing must meet some specified conditions, must meet some specified criteria. I love this. And then you're told here, and it would in practice cost a lot to do so. So when they say that in practice it could cost a lot to do so, it means that the lessor will find it disadvantageous to him to substitute. That is basically locking out the substitution element. Yeah, why would he substitute? And really, this substitution, perhaps there are things that he has to meet, the logo, branding for our company, etc., for this airplane. So if he's going to find it very disadvantageous to substitute, hey, that's another language of telling him that you can't substitute. So the question is, do we have a lease component? Do we have a lease component in that contract? Oh, yes, it is there. Number one, this person is giving us the right of use. Even if the pilots are his, the benefits that will be coming out of this aircraft being used will be coming to the lessee. Very, very important, very, very important. And then you can see that this person, even if there is a clause that talking about substitution, there is actually no substitution possibility. There is actually no substitution possibility. Okay. So you got the third example, or rather, is there a possibility? Is there an identifiable asset? Yes. The airplane is explicitly referred to, and the substitution right is not substantive, as they would incur significant cost. Does the customer have substantially all benefits during the period? Yes, it has exclusive use. Does the customer directly use? Yes, the customer decides where and when the airplane will fly. So this contract contains a lease it contains a lease because basically, ladies and gentlemen, what I would want you to understand there is that such kind of a contract contains a lease simply because of what here? There's a specific aircraft here. I'm the only one in these cases, and gentlemen, who has got exclusive benefits, right? And of course, I'm the only one in this case, even if the pilots belong to this lessor, I'm the one who has a sole responsibility of telling the pilots, hey, fly this thing east, hey, fly to west, etc., etc. So this is a lease contract. Now, how do we value the liability arising here? Remember the moment you sign for the right to use this particular asset, you'll be having a liability. And this liability, remember, you'll not be paying it once. No, this liability will be paid through what we call lease rentals. So month number one, month number two. So because the lease rentals are futuristic, then the liability will be the present value of all those future cash flows. You discount. Present value of all those future cash flows, you discount. All right. Now, it includes the following. present value, how to value the liability, present value of the lease payments. So the lease payments, you discount them, you present value them, where the lease payments are all the fixed payments. Number two, any variable payment, so long as it depends on some rate, on some index, and that index is known in advance. Like in Nairobi, for example, we know in Nairobi here, whenever you take someone's house, there is some variation there. And the variation in this rental, lease rental, that variation is pegged on some index. So they'll tell you, for example, after every 2 years, the rent will go up by 10%. You see, you can predict it. You can see that cash flow in the future. You can look for it and then you discount it. Very, very important. So if it's variable, there must be some parameters in advance. And then number three, I mean, we have the residual value guarantees. So guarantees, for example, this person tells you that on the fifth year, we shall be able to transfer this asset to you. And you're able to see the residual value. For example, by that year, this vehicle will be worth this much. So there is a guarantee this person has given. So long as that guarantee is given, I'll take that amount, discount it. It will form part of what year? It will be reducing my lease what year? Lease liability. And at times the residual value could also be a guarantee for the lessor. You're telling this lessor that by the time I'll be returning this car to you, it will be worth this amount. So it becomes an obligation on your side. It becomes an obligation on your side. We shall be looking at these examples practically. You will be able to see what we are talking about. So, ladies and gentlemen, here we have any probable purchase options. You have to consider them, termination penalties. Then for all these liabilities, what are we acquiring? It's an asset. So we have, in this case here, the right of use of an asset. How do we value it? The first thing that you bring in as your right of using the asset is the lease liability that you ascertain here. So the first thing, which is the base, is the lease liability, the present value of payments. And then number two, we have any lease payments made before the lease started. So before the lease started, all those expenses you incurred to build up your case, right? All those arrangements, legal, etc., right? Any restoration cost, if later on you'll be told by your landlord that when you will be vacating my premises, you must pay it. So all those restoration costs in this case here must be factored for and provisioned. There must be a provision for that. So you'll be debiting the asset, right of use of the asset here, right? And then, of course, I credit what here? The liability. I credit the liability. Very important. So I'm told here, any restoration cost, debit the right of using the asset, you credit the provision. And all initial direct costs must always be done what? All initial direct costs, like now I spoke about the legal fees, etc., must always be put in as an enabler for you to be able to use the asset, must always be taken in as a right of using the asset. So given a very good example here, we have a 3-year lease term whose annual lease payment is paid in arrears. So the lease rentals, 5,000 every year. The rate implicit in the lease is 12.04%. The present value of the lease payments is 12,000. So basically, this is your lease liability because it has already been discounted. It's a lease liability. So answer, the lease liability is initially the present value of future lease payments, which here is given as 12,000. So that is very important. So they're telling us, ladies and gentlemen, that we have a lease liability of what here, 12,000, which is exactly equivalent to the present value of the future, those 5,000 that were being paid there. You present value it, you present value them, you discount them. And once we have the present value as 12,000, then what we shall do is to come here, we know now that we are liable up to 12,000. And once we clear that liability, then what will happen, that amount we shall pay will be the one giving us a right of using the asset. So basically, two things I'll recognize: initial measurement, initial recognition. What I'll do is to recognize that I have an asset and a liability. So in this case, I'll come and debit. We debit the right of The right of use of an asset. It's an asset you have created, right? And then you credit the lease liability. According to Ifrs 16, you credit the lease what year? The lease liability with how much? With 12,000. With 12,000 like that. 12,000, 12,000. Very important for me to appreciate like that. Now, the other thing that you're supposed to know is that now this right of using the asset is an asset. You have a physical asset here, which has to be depreciated. Like in this case here, they have told us the asset is a 3-year asset. IFRS 16 recommends straight line depreciation. So it means that depreciation from the asset here every year, depreciation will be 12,000 divided by 3, which gives me 4,000 per annum. So the 4,000 per annum is what I'll be taking to my income statement as depreciation, right? So of course, having the depreciation at the end of every year, I'll be able to get the net book values to post to my statement of financial position. Very important for me to appreciate that. How about the lease liability? This lease liability, you can't depreciate a liability. Liability will always go down as you pay, So it goes down as you do what? As you pay. And of course, in this case, if that is the case, then you are amortizing. It's like a loan. So basically for the lease liability, you need a loan or a liability amortization schedule. You need a liability or a loan amortization schedule. Very important, we are told here. The asset is then depreciated at 4,000 per annum over a 3-year period, and they have shown us here how to do it. The lease liability uses amortized cost. So amortized cost is quite an easy thing to remember. It's quite an easy thing to remember how it is done. So this amortized cost, this is how we do it. The amortized cost, this is how we do it. The amortized cost, this is how we do it. So amortized means reduction. As we pay the obligation, then our liability goes down. So we shall have our opening balance here. We shall have our opening balance there, right? We have the interest on this balance, all right? Interest on the balance, and then of course we shall be paying. So we have the payment, and then now we have the closing balance. The closing balance, have a nice table. So have a nice table. So we have year number 1, year number 2, year number 3. So we have year number 1, 1, 2, 3 like that. So opening balance is your total liability which you initially recognized, which is 12,000. So this would be 12,000. And then of course the closing balance at the end of year 3 has to be 0 because this is a 3-year lease asset. So this one here, of course, must be 0. Now the payment. What have they told me about payment? I'll always start by recognizing the low-hanging fruits. So for the payment, this is what they have told me in this question. They've told me that I'm paying how much here? Annual lease payments is 5,000. So every year, 5,000. So payment, we have 5,000 payment every. So you're paying me off to capture this in what year? In a bracket like that. And that is it. Now from there, come and give us interest. Interest, they have given us the implicit rate of interest. They have told us it is 12.04%, the cost of capital, 12.04%. So 12.04%, then I should be able to get. So where did I get this figure? Of course, I never guessed. So ladies and gentlemen, here we have our rate implicit in this is 12.04%. So 12.04%. So then what do we have here? So we have here the first year, this has to earn interest. So it will be 12,000 times 12.04 divided by 100. 4%. So the first year I have 1444.8 like that. So then how do I get closing balance? So remember the interest is increasing the obligation. So you take the principal plus what year the interest, and then you subtract what was paid in the year. So we have plus 12,000 minus 5,000, which gives me 8444.8 like that. So the closing balance of year one becomes the opening balance of year two. So the opening balance here will be 8444.8 like that. Let this amount earn some interest. So times 12.04 divided by 100, which gives me 1016.75 like that. So take this amount, add to your opening. So plus 8444.8, subtract what you pay, minus 5,000, which gives me 61.55 like that. So this automatically is the closing for year two. It becomes the opening for year three. So we have here 61.55 times 12.04 divided by 100, which gives me 537.17 like that. So this, of course, increases my obligation. So I will take this plus the principal plus interest. So plus 4461.55. Whatever I get there is what I'll come and subtract what I pay in the period. So minus 5,000, which in this case I can see it's giving me minus 1 point something. So that minus 1.1, I can't show it. I know the difference there is coming because of what here? Rounding off errors. So I can't show that. I know ultimately the obligation must be extinguished. It must be what? It must be zero. So then what does this mean? It means that in my liability section, when I come to the lease liability, end of year one, this is the amount I will show. 44.8, right? Now, the other thing that I'll do is to take this interest. This interest has to go to year one's income statement. So year one income statement, you take this 1444.8. So that is it. Once you have a loan amortization schedule, a liability amortization schedule, you'll be able to get the closing liabilities that you take to your statement of financial position. So this one here for the respective years, this goes the statement of financial position, and this automatically goes to the income statement. This automatically goes to the income what year, the income statement. So you've come to the end of this particular session. I hope you've seen how good our notes are. Of course, if you need those notes, we are publishers of these books that you can get at Textbook Center, Savanis, or even call us. You have our number, and then you'll be able to take advantage of our textbooks. Of course, working that together with our videos, then it'll be sorted out. Remember, Zoom classes work magic. That's our number, 0719 525,000. Thank you very much. See you for lesson number 2 of Leases.